Welcome to today's Explainer. We're diving deep into the June 24th, 2026 edition of the Wall Street Journal. And honestly, we are looking at a beautifully chaotic day in global business. Seriously, from massive tech sell-offs to multi-billion-dollar robotic IPOs and absolutely colossal infrastructure bets, the market is sending us incredibly mixed signals right now. So let's jump right in and unpack today's top business news.
You really can't talk about the market today without starting with a drop. The tech-heavy Nasdaq Composite took a steep 2.2% plunge. And this isn't just some minor blip. It's a deepening global tech slide that's actively dragging down major indexes. Over the past week, the Nasdaq has slid for 4 of the last 5 trading sessions. We are seeing a sudden, sharp reversal right on the heels of stocks posting some of their best 2-month streaks in history. So yeah, the stakes just got very high.
And when you actually look under the hood of that Nasdaq drop, the bleeding is intensely concentrated in the semiconductor space. Memory chip giants Micron and SanDisk both plummeted by more than 13%. I mean, these are the very companies whose parabolic gains have practically been lifting the entire stock market to near record highs lately. Well, they were. Now, they're leading the charge downward, trimming massive 2026 gains, and honestly, leaving investors absolutely battered.
Section 1. The Macro Bleed. Let's look at the exact drivers behind this tech sell-off.
To really understand why the bottom just fell out of these high-flying tech darlings, we need to look at the exact anxiety cocktail investors are currently drinking. First up, the looming threat of higher interest rates. Derivatives traders are now nearly pricing in 2 rate increases this year. Second, we've got incredibly stretched stock valuations following that massive spring rally. But the third point here, this is the real kicker. There's a growing fear that the billions upon billions of dollars being poured into AI data centers and infrastructure, it's going to drastically outstrip the actual, tangible corporate profits that AI generates.
And Julia Herman, a global markets strategist, brilliantly illustrates the core vulnerability we are seeing right now. She points out that semiconductors are just inherently more volatile than the giant software companies, the hyperscalers. Because chip makers are way more rate sensitive, they are completely exposing the market to the consequences of tighter monetary policy. Think about it. When borrowing costs go up, the massive capital required to build out those AI chips and servers, it becomes a whole lot harder to swallow.
Which brings us to Section 2, defying gravity in the capital markets.
Because while the broader tech market is bleeding over macro fears, corporate capital markets are telling a wildly different, aggressively bullish story. Just think about this eye-popping number, $25 billion. Despite the absolute carnage in tech, Elon Musk's SpaceX just finalized terms for a massive bond sale. This is their very first foray into the bond market, and they're doing it to fund heavy spending across rockets, internet infrastructure, and of course, AI.
To really grasp the market's confidence in SpaceX here, consider the spread, which is essentially the extra risk premium investors demand to lend them money. SpaceX secured a remarkably tight 1.4 percentage point spread on a $6 billion 10-year note. Now, contrast that with Oracle. Oracle is another massive BBB rated company burning cash for AI, but they're trading wider at 1.6 points. Simply put, investors are actually demanding less money to take a risk on SpaceX. It signals immense market confidence in Musk's venture, even as it burns cash on an extraordinary rate.
Moving right along to Section 3, Agility Robotics and the Humanoid IPO. Shifting from the launch pad to the factory floor, Agility Robotics is looking to capitalize on some serious pent-up demand. They make human-like robots for warehouses, and they are set to go public in a SPAC merger deal, which is a specialized move to list on the public market. And get this, the deal values them at a staggering $2.5 billion. They're teaming up with Churchill Capital Corporation XI, expecting to pull in over $600 million in gross proceeds from the whole shebang.
Now, the crucial takeaway here is that Agility isn't just relying on sci-fi hype. They have the real-deal institutional foundation to back up that massive valuation. When you look at their heavyweight backers, you got absolute giants like Amazon, NVIDIA, and SoftBank. And then looking at real-world deployment, their flagship robot Digit, which automates tasks like moving heavy containers, is already being used by Amazon, the logistics company QXO, and Toyota Motor Manufacturing Canada.
But you might be wondering, why this massive rush for robot workers right now? Well, CEO Peggy Johnson points straight at a major economic reality. Older workers are retiring out of the labor force, right at the exact time there's a renewed political push to reshore manufacturing back to the U.S. Companies are literally desperate to fill that labor gap. To meet that soaring demand, Agility is actively ramping up its Oregon factory to eventually produce 10,000 units a year.
All right, Section 4, Walmart versus Amazon, an absolute battle of corporate strategy.
We just mentioned Amazon backing agility, right? Well, Amazon is fighting a really fierce war on another front entirely, digital advertising. And the big challenger? Walmart. Let's look at how methodical Walmart's strategy has been over the last couple of years. Back in 2024, they bought the TV maker Vizio for $2.3 billion. Then, they spent 2 years integrating Vizio's operating systems directly into their store brand TVs. And now, they're dropping $1.4 billion on the French ad tech firm Vibe.co. This is a massive, closed-loop play. Walmart sells you the TV, and now they control the targeted ads shown to you on it. It essentially allows businesses to bypass Amazon's ad network entirely. Pretty clever, right?
Okay, shifting gears. Section 5, Tesla's rebound in the EV market. Amidst the broader tech gloom we were discussing earlier, Elon Musk is actually finding a massive microeconomic win overseas. Consider this stunning recovery. After more than a year of decline, Tesla saw a more than twofold jump in European sales. In May alone, new car registrations for Tesla models hit over 28,600 units. That is an over 100% increase year over year, marking their fourth consecutive month of growth on the continent.
And we have to note, this momentum is incredibly hard-won. Tesla is currently fighting off fierce Chinese EV rivals like BYD and Leapmotor, who, by the way, are also seeing major registration increases in Europe right now. On top of that, Tesla is steadily working to recover from a period of customer backlash that stemmed from Musk's political involvement in the US. But regardless of all those hurdles, European drivers are clearly returning to the brand in massive numbers.
Let's zoom out for our final segment, Section 6, Energy and the Nuclear Renaissance.
To close out our explainer today, we really have to talk about the backbone of all of this. I mean, all the AI, the robotics, the reshoring of manufacturing, it all requires a truly massive amount of power. And that brings us to our final headline number, $17.5 billion. The Energy Department is pushing billions in loans to utilities to finance new nuclear power reactors. They are actively trying to stimulate a nuclear fission renaissance just to meet the exploding energy demands of the modern economy.
So, let's tie it all together. We started today by looking at a tech market bleeding out over the fear of rising interest rates and unproven AI profits. Yet, as we've seen throughout this briefing, companies like SpaceX, Agility Robotics, Walmart, and even the US government are continuing to put billions upon billions of dollars into futuristic infrastructure, AI, and energy. It leaves us with a pretty provocative thought. As the cost of borrowing climbs and the market grows increasingly volatile, will these massive bets on tomorrow be able to survive the economic realities of today? Thank you so much for joining this explainer, and keep learning.